Stock market investing is easy. Money, 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 money. Until your first big loss. Can you handle that loss? Or will you walk away bankrupt? Well, this is the time now to be financially educated. We want you to be financial freedom right here at Barry Charles. In this very moment, you can be your own boss, make your own decisions, find your identity in your stock strategy, and live a life and leave the rat race and live for fire financially. Retirement early. Yes, that's what we want to do. We want to be financially independent, ready to rock and roll towards the future. And in this video, we will learn about long-term investing strategy to sustain you through life for generational wealth towards a greater you. Yes, you will go deep, deep into the well. You got to dig deep right in. You got to go through all the hard knocks, learn all the learnings you get every time you invest, and then you will find a strategy that works for you. And once the water rises up the well and out to the side, you will see money for days as you make financial freedom right here, right now with Barry Charles. Welcome, guys and gals, to the channel. I hope you're having an amazing day out there. I really appreciate your time to come spend a little time with me today. If you can subscribe to the channel and share this video all around with all your friends, it will help me out greatly and also make you all generational wealthy. Yes, that's what we're here to do. So thank you again for joining me today, and let's get to my process towards stock picking. Well, let's start with some context here, and let's start with my journey for investing. Yes, when I first started investing, I was investing into ETFs. That's where I was investing into. And I made a little bit of money, nothing much. And then I thought, I've got to go and play with the big boys. And it's time to individually pick stocks. And my first one was Amazon. I bought a few stocks in Amazon. Obviously, you've got to start somewhere, folks. And it's still quite a bit of money, a few thousand for some people. So just buying into Amazon was my first thing. And I made $1,000 there. So I thought, oh, yep, this game's easy. And what I probably did next was I probably just invested into too many stocks that I had no clue what I was investing into. A couple of them that I should have stayed in, United Health Group and Tesla. But I really had no clue what I was doing at the time. I was looking at financial statements and all that, but I was not really thinking long term, which I probably should have been. I was thinking long term, but I didn't like the stocks going down, and that's where the pressure really gets into you, and you need to go through it a few times till you get used to it, and then you realize that's going to happen with stocks, and you got to realize that, and you got to be able to decide whether this company is going to be great long term. If you think it's going to be great long term, you keep buying, but then you got to realize there's a point where you got to sell out. So I'll just give you just a quick strategy here, folks, for investing, if you're investing into a stock long term. There's a few things when the stock price goes down. Is it because of media and all the bad stuff, or is actually fundamentally something wrong with the business? So this is the difference between buying the dip or you needing to sell out. If the company is just dropping down because of everything, bad news, bad this, or maybe they've had a bad quarter because of something out of their control, then this company is still investable. But when the fundamentals get real bad, they really are just like consistently, say quarter after quarter, they're just losing money, especially for a company that was profitable. And then you got to go, hey, you got to look back at your strategy and say, hey, is this company still profitable? Is it still going to do the things into the future? And if it's not, then you got to go, it's time to cut it. You got to cut your losses. That is the big thing. You got to cut your losses where you need to. Sometimes you can hold on to a stock for too long and be absolutely in. There's countless stocks that people can be in And like recently, Silicon Valley Bank and First Republic Bank, and obviously you got stocks like Beyond Meat and Tilray, the cannabis company. If you bought into these stocks at the wrong time, GameStop, you would have lost a lot of money. But yeah, getting back to my investing. So I learned a bit in this phase of these stocks here, thinking, oh yeah, this stock's a good one. This one's, yeah, I'll buy into this one, and I was just getting over diversified and really only having a few stocks there, and this company a few stocks in there instead of being concentrated. And that's when I started realizing I need to have a more concentrated portfolio. Invest in companies I totally understand and know where I see the future lies, and my target prices where I think they need to go. Is there a target price where I need to sell, or is there, because there is some stocks you buy long term, and there's other stocks that you can see potential growth now. You sell it when you think it's right, and then go again. But the only problem with this strategy, with buying and selling frequently, you pay that big capital gains. If you wait for a year, that's better for you. You have less capital gains. It's half the price in terms of tax. Ideally, you want to buy stuff for the long term and don't sell it at all. And that way you avoid a lot of the taxes. But that is not always the case, because some companies change over time and you need to sell out. And another strategy that people can look at buy is yes, when you make a profit, sell out your initial investment and keep the rest in there. And that is another way to do something. So you always got money invested, but again, out of that money you still have to pay the tax. So that's the only question when you buy and sell frequently. So I try to avoid that as much as possible if you can. Yes, but how do we avoid these disasters now? What do we need to do? Do we just buy into game-changing businesses? Like, is this what we're looking at? Is that where the future is to make money? Game-changing business is a part of the strategy, but it's not be all and be all, because just giving you an example of, say, AI at the moment, and it's one of the big things happening at the moment, or you can say autonomous driving, but not as big a thing. But AI, say there's 100 companies out there trying to do AI, you're only going to see 5 or 10 actually survive. And a lot of the big companies are already doing it, so it puts a lot of pressure on all the newer companies to really more than likely get, if they are good, they will get bought out by the bigger companies and will get just put into the big ecosystem. So that is the issue for the smaller companies. And obviously, if you're trying to invest, yeah, so to me, some people would say those 100 companies, right, with AI, just put everything, put a certain percent into each one, 1% into each one of these 100 companies, and watch something go boom, and there you go, you make a lot of money. That is one way to invest, and it works for some people, but I think for most people it does not work out in your favor. So you want it to be in your favor. You might as well go to the Russian roulette table if you want to invest like that, and just hope for black, or whatever the case may be. But to me, I think you can do a lot better and make a lot more money over the long term by following my strategy. So what do we need to do? What would I call my strategy? It's probably a mixture of growth, value investing, and dividend investing. If you can find companies that do all three, then boom, thank you very much. That is the perfect scenario. And one of the companies I'm going to talk about has that. There's probably other companies that will grow more than this company because it's already up skyrocketing. So, but I see this company as a nice solid play. I don't have to worry about it. Just sit and forget, and watch my money grow. So let's have a look at some of my key metrics into investing when buying a company. Well, first of all, I think a lot of people, this is one of the biggest ones that I think most of Wall Street do look at: revenue growth. How has the company gone with its revenue growth? For me, I only look short term. I only look at the last 5 years or so. I don't go back 10, 20 years. You can go that far back, but to me, you're just wasting your time. You only need to go back 5 years. you can see what's happening with the company for the future projective outcomes you believe in by just looking at the last 5 years. To me, I'm really looking at the future potential, but it's always good to look at the past. But it does not guarantee the future. So you always got to believe in what you project the future to be, but always also be realistic and understand you could be wrong. So you might have to change your idea on a particular company at some point down the track, because otherwise you get left doom and gloom, and then by the time you realize you have to sell, you've run out of money. So let's have a look at Apple. For instance, I thought this was a good company to give you a better understanding of all this. In 2019, it was 260 billion in terms of revenue, and now in 2023, expected to be over 400 billion. So that's unbelievable. So over the last 5 year span, that is a growth of 70% over the last 5 years. So 14% revenue growth roughly over the last 5 years. So for a huge company like Apple, over 2 trillion, it's good. Good investing in Apple. It's not a game changer, no doubt about it. Apple has got. I'm going to talk about that later, about what Apple could do to be a game changer. It's just something they need to work on, because at the moment they've just been a bit more solid. They're making sales, but they could do a lot more, which I'll talk about a bit later when I talk about Tim Cook. So stay tuned for that. Obviously, the next one to look at for me is net income. Yes, you got your top line, you got your gross profit, but at the end of the day, what's your bottom figure after you've paid all the expenses, you've paid everything? What have you got left to do some sort of investing in? So the net income, yes. What can we? What does Apple have here? So in 2019, they had $55 billion in terms of net income, and now they're at $100 billion projected in 2023. So that's roughly a 92% gain in 5 years. So an 18% annual conversion rate of net income. So that's very good for a company like Apple. And net income is always a good way. And another metric to look at is the cash they have available, say, to invest into, because this is net income's one part of it, but what cash have they actually saved up, stockpiled, so they can make acquisitions? This is also another segment that you can look into and dive into more. Next off here for me, dividend growth. It's a huge one for me. If it's a dividend stock, it has to have dividend growth. If it doesn't have dividend growth, that's when you've got to decide, do I have to change my strategy? And it's a company currently that I might have to change my strategy here. I've talked about it in the past, NRY. This company, a REIT company, has a very high dividend yield at the moment, but there's a possibility they'll cut it. If they cut it, that's going to be the question. Where you've got to realize, if they're cutting it, the stock price is going to tank very quickly. So that's going to be a question mark on that company. So that's something you need to look at if they're going to cut the dividend. And if they're going to cut the dividend, you're going to expect some losses. So it's whether or not you sell out now before they take their risk out of play, or do you keep it and ride the wave and hope it doesn't happen? That's a question for me I have to think about going forward in an investment. Yes, but in terms of dividend growth, Apple, for instance, has a 9 years of dividend growth. So the company continues to raise dividends, so you're getting a little bit more money each year. So I'm fairly comfortable Apple is not going to deliver cut in the dividend anytime soon, and probably a long time into the future, because their payout ratio, which is basically what the company's earnings is and how much they have paid out to the dividend, and their percentage is only 7.8%. So only 7.8%. That is beautiful for us, because they can easily go to 50%. And I know they're not going to go to 50% probably for 50, 100 years, because it's a very slow growth rate. There's something with Apple, if you're expecting big growth rate in the dividend, that's the wrong company to invest into. but I see a lot of growth in the company. But I think the dividend will go up eventually, bigger and bigger, once the company probably stabilizes more. But I'm hoping that Apple is going to continue to grow and grow and grow, and you'll see more and more profits on the share price as well. Yes, another key metric for me when I'm investing into a stock is shares outstanding. So what is shares outstanding? It's basically all the stock that is available to buy right here, right now, and what the company does with that, there's two ways around it. They can buy back the shares, which makes you own more of the business, or they can issue more shares, which means they are diluting you, and more money, more shares are coming on the market, making you own less of the company. So that's obviously an issue if that is happening with companies. Sometimes it can be a good thing, especially if the share price is high. To get that more revenue coming in, it's potentially a good thing to do that. But it's good for the business, but it's not good for the shareholder. So that's the hard thing between doing that sort of stuff. But it is a smart way of generating more money when the stock price is high. So that's why some companies do it that way. But it does divert from long-term investors staying in the company. So it's a bit of a hard situation to be in when it comes to that. But Apple's case in 2020, they had 17.5 billion shares outstanding, and now currently under 16 billion. So they are really helping you get some money. It's very good. Very good that they are buying back more shares, and they're going to continue to buy back more shares. Is something Apple does frequently. And obviously another thing, if you're in Apple stock, one thing you can see probably another stock split happening at some point in the future, because they're welcome to do that, and then you own more and more shares. Not necessarily means you don't own more of the business, but you'll get more shares going forward. Yes, but the last one here I want you to all think about here is the management team. Yes, you need to have a good management team if you want to be successful in any business, especially to be the best of the best, the top of the tops. Your management team needs to be in the top 1% to be absolutely outstanding. So let's have a look at Apple's, for instance, their company, and let's look at their CEO, Tim Cook, where his history lies. Well, since 2011, he's been the CEO of Apple, but before then, he was the Chief Operating Officer, which had sales and management of all company all over the world globally. He's also worked for IBM for 12 years. He was part of the running the Apple Macintosh team for a while at Apple. He's been at a few different other companies during his time, so he's really has had a lot of business background in corporate. So when I'm talking about management team, this is a big thing everywhere. So you got to go all the way, your building blocks, all the way from the bottom up. So the people at the bottom need to understand the CEO's vision and feel part of that vision, that they are doing the right thing for this business. And that's the hard thing when you get to that bottom line, because you're going to have people that are there just for the money, but you need to find the people that are there, they want to really grow your business and improve themselves as well. You can find those people, that leads from the management above them. So the management need to see those people, promote them quickly. And the people that are not necessarily doing what you're doing, you need to find out why. Because you can change people very quickly as well. If you can find out why they're not doing it, is it because of the management? Is it because of something in their personal life? There's a lot of things. Sometimes it's just bad performance. It's just completely bad performance. Out the door, see you later. But sometimes there is other factors that can change, and the person can turn it around and be absolutely outstanding for your company. So what does the future hold for management teams? So for me, so then you have your management teams. Then you might have a team that's a project management side. So you need a project manager being able to look at every sector of where he or she is project managing and being able to make improvements where needed. We need to cut costs. Where one part of this thing needs to just be cut right now. It's not going to make us any money. Let's get rid of it and let's move on to something else. You need teams like that to really make a strong presence for your company. So you get to the bottom line, you're making great money as well as providing for great value to your customer basis. So in a nutshell, for me, in terms of my investing strategy, I'm looking for growth potential. For me, that is one of the key factors. I need to see this company, I think in 10, 20, 30 years, they're just going to keep growing and growing and growing and be an absolute conglomerate in this sector. And I believe they're going to be there for the long term. I'm looking for value. So I want the company to be... so, for instance, you want to buy the margin of safety. To me, I like to be a 50% margin of safety. So if the stock's at 100, it's worth 100, say, on valuation, I want the stock price to get to 50, and then I've got 50% margin of safety. If that happens, it's a great time to buy. It doesn't mean you'll ever get it in each company. Sometimes some companies may never get there. So it's up to you whether you decide to take the lesser gains or find a company that is undersold, like a Meta had been recently, and a few other companies like NVIDIA and Shopify and others. If you got in at the right time, well done to you. It doesn't, and if you didn't, it doesn't matter. Move on to the next one. There's always going to be opportunities. You just need to try and find them. But yeah, so in terms of that growth, I'm looking at companies that I think are going to go 100%, 500%, 1,000%, even 10,000. It's hard to get those real like the big $10,000 percent increases these days. You're really only going to find that in the small market, in the small companies that just go bonanza. But most of the time these days, by the time you're able to actually buy these companies, because a lot of companies around the world, especially in the US, you cannot buy the companies until they get onto the $1 billion market. So that's so you can't get onto the OTC market, which is an issue for people outside of America to try and make money on those businesses. If you can find businesses then, often those are the ones that will make you the biggest money long term. But they also, when you're looking at small companies, 90% of them fail. So to find that 10% is very hard. So sometimes it's better just to take the safe route and just go on the bigger companies. But that doesn't mean you can't do that. I'm not saying not to do that, because it's definitely a lot of people have made money in the past. But people always talk about their winners, not their losers. Yeah, so that is basically me about my stock strategy, how I like to invest. I really try to find a company that has a great moat as well, where I think it's going to lead into the future. But don't get confused with with a moat and you just buy it. Yes, it can have competitive advantage, but if the valuation is not right, do not buy. I have to tell you this, do not buy if the valuation is too high, because more than likely you could overpay completely for a stock and they may never get there again. Not always the case. Most of the time it will go above that again. But there are sometimes you just have to wait, and then boom, take the big payday into the future. And don't get scared if you've bought lower and it keeps going lower. If the fundamentals are right, just keep buying. If the fundamentals change, that's when you got to look to sell. Anyway, thank you very much for watching this video. Thank you for subscribing. Share this video all around the world so everyone in the financial space can get themselves more educated on how to invest. If you like these videos, let me know in the comments below and I will make more of these type of videos. Thank you very much. Have a lovely day out there.